Hey everybody, this is Jose. We are about to start, 20 seconds to go. Let's use this time for a sound check. Please go ahead and give me some confirmation in the chat box with a quick message so I know you hear my voice, I know it's all good, and we are ready to start. Thank you so much. Very nice. Thank you, everybody. So we are just reaching the top of the hour here, so I'll just maximize our introduction slide as we always do. Very nice to get your confirmations. How are you, everyone? Ready to trade? Nice. Tui Conde, how are you? Bojan, Pansy, Leslie, Jerome. How are you, everybody? It's very nice to join you. Yesterday and today we are getting together at a different time compared to what we normally do, isn't it? And I said that yesterday, if you were in the session, I am running a special Forex class this week. And therefore, there is a little bit of an impact on the normal schedule we normally run. Okay, but this is only this week. Okay, so everything will be back to normal next week. Anyway, let's begin, everybody. Today is 26th of February 2020. My name is Jose Blasco, if I haven't said it already. I will be your guide, and the plan is to get into longer-term opportunities in the marketplace. We're getting together. This is a practice session. This is a trading session. We're going to jump into the market live. We'll be executing trades as well live. You are certainly welcome to work with me in those trades and those plans. The only thing I will leave to you is to decide if you want to utilize real capital, paper money, large size, small size. All of those parameters, of course, are too personal for me to say. But when it comes to planning the trades and the parameters of the trades, certainly I'll be working on you on that. And feel free to ask questions during the process if you have any question, okay? As always, before we start, we have a disclaimer, so I'll be quick to read it. Let's go for it. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And this is the proper official introduction for the session. And I am now moving into TradeStation to look at what's going on out there. And what's going on out there, as you can see, if you have been watching the markets, you have been watching the VIX for some time, it's a major movement on the VIX. I mean, if I look at the daily time frame of the VIX, we hit the 30 mark. Okay, we hit the 30 mark. We were not trading at that level since December last year. Okay. December 18. Okay, so it's let's call it a year and a half ago. Okay, so certainly this is a powerful level of premium built in the options markets, and we should be able to find opportunities that allow us to take advantage of this. Okay, when looking at the VIX, at the S&P though, to be honest, everything looks quite normal. You know, we're having a correction in the context of an uptrend. The both climates that have been happening on the S&P, multiple climates in a row, were very lengthy climates to the upside. They were exceeding the statistical number 10. Was being exceeded multiple times, okay, and every time we had a correction, then it kept going, okay. So what's happening? We're dealing with a pretty powerful market, and yes, of course, there is viruses out there in the world and everything else. But again, as traders, we need to remain objective, and I love statistics because statistics help us to remain objective. Basically, we are candle number 3 of a climate where when going down should be of 4 or 5 candles. So basically what's likely going to happen based on probabilities is to see the market just falling a little more, maybe just to hit that UFO, and from there, go back up to something, let's call it quite normal. And if that was to be the case, you probably know, we talked about this before, that the VIX, that represents the level of premium of options out there in the world. When I say the world, I mean the US market. Those levels of premium normally move inversely compared to the direction of the market. Not always, not exactly inversely, but somehow when the markets fall, the VIX tends to move higher. When the markets drop, when the market rallies, the VIX tends to fall. And basically, we are hitting the 30 mark, which is a nice level of premium for options. And those options premiums are likely going to go down, especially if the S&P goes up, which everything suggests that's the case. So in days like that, we have something very joyful in front of us, which normally I don't get into do market analysis the way I'm doing today, isn't it? So today I'm explaining all of this because in days like this, the joyful event is that we have decent levels of premiums for us to collect. The downside of those joyful events, okay, everything in life got, they had the good and the bad, right? So everything has two sides. So the problematic situation that we have in front of us, though, is that when you have such a spike in premium, typically it means the markets have been moving really, really strongly in a particular direction. So what happens? When you get into your scanner looking for pure non-directional trades, what did we get? Nothing. Okay, there is no stock in the whole US market that is giving us technicals that suggests a sideways market for us to take advantage of premium. And therefore, we cannot be purely non-directional. We need to decide on which direction we want to play. And therefore, today, we're going to work a lot on neutral trades, either neutral trades to the downside, neutral trades to the upside, because pure non-directional trades are not available based on the scanning parameters that is basically looking for markets that are likely to remain sideways. Okay, we have nothing like that at the moment, given the power of the market movements that we see at this moment in time. Okay, so again, the scanner is keeping us safe. Okay, but again, that's the downside of this situation where you got a lot of premium. Then typically it's difficult to set up those iron condors. Okay, it's normally more time to trade the credit spreads. Okay, so we're gonna have that, and also a few opportunities to go long or short. Okay, we're gonna be working on those too. Only few. Why only few? Well, because if all premiums across the board are becoming very expensive, and we see that on the VIX, and to be directional, we have to buy premium, and we want to buy premium when it's low, and we have parameters that filter for low premiums in the scanner. Then of course we're gonna end up with less opportunities. Okay, so we're gonna have few opportunities to be directional, and many opportunities to do credit spreads, and therefore this is the plan for today. Okay, so a little bit of a lengthy introduction today, given the fact that we have this very powerful spike on the VIX, and I wanted to take a little bit of time to explain it. So when you get to see that again sometime in the future, then you know what it is. Okay, very good. So yeah, I'm just double checking the chat box that all of you are good with everything and you are following. Okay, so let's begin. So obviously we have very few opportunities to do credit spreads to the upside, more opportunities to do credit spreads to the downside. Okay, well, given what I just said about the climate on the S&P, I would like to begin looking at the opportunities to the upside, which really we see two opportunities, but really there is only one, because SDS, that's an ETF. Okay, so that's, if I put my cursor next to it, okay, it should give us the name is the ultra short S&P 500 Pro shares. So that's an ETF. Okay, so we're not gonna do options on the ETF, but we could certainly take a look at GILD. Okay, so let's take a look at GILD and see if there is an opportunity here. I am also willing to load GILD on TradingView, so I can check on earnings. Okay, the past earnings took place on February 4. The next earnings will take place on 30 of April. So certainly we got plenty of time there. When looking at, let me delete all the lines that we have from a prior session. Okay. So when looking at UFOs, certainly we have 55% probabilities. We got 1 and 2 UFOs on this time frame. So that would be number 1, and that would be number 2. Remember, when doing credits, oh, by the way, wait a minute. I am looking at the daily time frame. I should be looking at the 55-minute time frame. I never switch back there. So let's do that. Yeah, so we have 54%, and we have UFO number 1 is here, UFO number 2, UFO number 3. So we have multiple UFOs right there. Okay, and the reason why I'm drawing the lines is because I want to also give this market a chance of giving me UFOs on the pre and post market session. So let's take a look and keep 54% in mind. So 54 remains 54, okay? And notice that at this moment in time, we still have this UFO still shows here. The other ones don't, okay? And then we have UFOs below, okay? So in other words, we can be quite confident using the regular session. If I was to delete the first line and relying on any of the two bottom lines here, we should be able to find a setup for a credit spread selling 66 puts or something like that. That should be a good way to do it, okay? But of course, we need to do that only based on very specific measurements, statistical measurements, okay? And we're gonna do that using Option Station Pro, and I am loading Option Station Pro as we speak, okay? So 1 second until this tool is loaded, and we're gonna be looking at it. Here we go. So let's load GILD. Let me see, JLD. So we got multiple expiration dates here. Okay. Well, when you have events like that where the VIX spikes, okay, it is certainly very useful beyond everything else. It is certainly very useful looking at the volatility measurements that we have here, and you can certainly see that the expiration date 2 weeks from now has a lot of premium built in. You may say, what about the first one? Well, the first one almost always have more premium built in. From an implied volatility point of view, a different story is that then you look at how many cents, how many dollars you get, and it's going to be very little because you only got 2 days left to expiration, and the Greeks, okay, the options Greeks, become a little bit of fake Greeks the closer you are to expiration, and 2 days from now means that the Greeks are totally unreliable. So that 77% number makes a lot of sense from a mathematical point of view, but it's not really useful for traders. So I'm looking at the next one, and that one is 55, then 48, then 45, and it's kind of a normal thing, that you don't have the same values here. But certainly when I see that and I see so much more premium built in here, somehow it's revealing the thinking of those options traders, which is that they expect that spike of volatility to remain active for like a week or so, which somehow coincides with the statistics of auto climate. Okay, so in the end, of course, the people that look at the markets with the proper tools, we conclude similar understandings. Okay, but anyway, so basically, when I look at that, certainly I would be inclined to plan the trade using March 6. So with GILD, we said that we could actually plan trades using all the way to April 20. But, if you were to use April something expiration, now you are benefiting here April 17. We're talking about levels of 40, where if you were to do the next week, basically now we are taking advantage of 54%. That's a lot more premium. That's like 30% extra premium, something like that. That's not a joke, okay? Let me rephrase that. Proportionally speaking, is 30% more premium. It's going to be less premium because you got 9 days to expiration instead of 51 days to expiration. So it's going to be less premium, but it's going to be more efficient by that amount, okay? So keeping all of this in mind, I'm going to look at the put side, okay? Because remember, we picked this opportunity from the scanner, looking at the neutral long opportunities, okay? So we are looking for the market to keep moving higher, stay the same, or drop a little, but not to drop massively. That's what we are looking at, okay? This is, of course, also compatible with our climate, okay? The scanner is taking care of that, so no need to check, actually, because the scanner is taking care of that. But basically, what we are doing is we're going to be looking at selling put spreads, okay? We're going to do credit spreads with puts, okay? So I'm going to move my mouse into the put side, which is the right side with the puts here. And I'm just going to right click to analyze and sell a vertical spread, okay? So why am I doing this? Well, because I want to find out, okay, what is the probability for price to travel from where it is to 1 standard deviation below, okay, one standard deviation below in this amount of dates, which is until March 6th, okay? And it seems that a one standard deviation would imply GILD to drop all the way to 6608. In other words, it is possible, it is doable, it will not be a strange thing, given the nature of GILD and the speed of movement at which it has proven to be able to move at, that particular market may drop to 66 point something. Okay, so what is our line? Well, our line is 66.49, and unfortunately, 66.49 it's happening higher than 66.11 that was down here. Okay, so in other words, those UFOs are too close. Okay, they are too close, and I remember when I looked at the pre-post market that there were more UFOs below. So I would like to consider and assess what if I was to use that UFO instead. That one is located at 62, and well, certainly now it's going to work amazingly well, isn't it? Let me move back to the regular session. Okay, so 62 is down here. Well, actually, yeah, that's the closest I have, right? Because I got more UFOs, 62.23, but that one is the next one. Okay, below this one, the next UFO ends at 62.82. So certainly selling options down here would be an amazing high quality trade. But of course, I mean, let's face it, we are not the only people in the world thinking about it. And I'm pretty sure if I look at the premiums, even though the VIX is very high, I'm pretty sure if I load all strikes for GILD, 62 and a half only pays me 15 cents, which is not acceptable. Okay, it's not acceptable. You probably remember our rules, but just in case, let me bring the rules into the screen. Okay, so we have a rule when trading options, when selling options, okay, to be more precise, where we don't, where was the rule? Here we go. Where we want to shoot for 35 cents, okay? That's what we are shooting for. And obviously, 15 cents is not there. So even though I would love to find a UFO setup that allows me to use March 6, given the fact that March 6 carries plenty of premium, well, the fact is that I cannot do that. And if I was to analyze this trade, I will need to be looking at the next expiration date, which is March 13. And if I look at 62.5, well, now I am getting 31 cents, okay, which is still not enough. Which is still not enough, and it's a matter of liquidity. Okay, the 13th of March, notice you got 17 to 45. You got lack of liquidity in that strike, and it's not providing me the 35 I need. So I'm basically obliged to move all the way to the monthly expiration date, March 20th. Here I'm pretty positive I'm going to find liquidity and premium. So let's take a look at what we got. So 25 to 35, that's 35, and now we have what we need. Having said all of that, if you were to look at the liquidity with the options below, okay, and basically you think about I buy this one, I sell this one. Sorry, let me rephrase that. I sell this one, I buy that one, okay, or I sell this one for 35 and I buy this one for 34, okay. In the end, how much premium are you collecting? So you are collecting what? You get paid 35 and you pay 34, so you are netting 1 cent. Again, the lack of liquidity, as you can see in the following strikes, it's really hurting the trade. Okay, really hurting the trade here, and therefore, we're gonna have to say no go for GILD. And the only problem though is that we don't have the UFOs in the right place. And this is something to be respected, okay? So if we had another UFO somewhere, so then it would be fine, but we don't. We need a UFO at 6611, but we don't have any there. So that's what it is, okay? So now, having said that, just watch it, okay? Because maybe a few hours from now or tomorrow, GILD may go higher, and then you could then use 6648 and do your put spread here by selling puts below the blue line and buying puts below the put you sold. And now you can do your put spread. But at this moment in time, as we speak, we don't have a proper setup, and therefore I will have to pass on GILD, okay? Okay, questions? How is it going right here? It seems that everybody has been quiet, apart from your hellos from the beginning part of the session, which I understand because you are probably focused and listening carefully, which is good. But at the same time, I'm always a bit demanding with feedback, isn't it? So you guys go ahead and let me know, even if everything is good, please just type good. That would be good to hear. Okay. Okay, so next one, to the long side, that's it. Okay, so now we're gonna start looking at credit spreads to the downside using neutral short opportunities. Okay, and what I'm gonna do is I'm just gonna sort this list from top to bottom. Notice that on the top we got the SPY, the Dow Jones. We're gonna pass on that, and we're gonna start our analysis with UNH, United Health Group. Okay, massive, major, dramatic moves on that particular market. Okay, um, a very weak stock. Okay, and hopefully, probably, we're gonna get to find great levels of premium in here. Okay, but let's check earning dates too, so we know when that's likely to happen. We can see the earning date is here, April 21st. Okay, so we got plenty of time to use basically any expiration date we want. So let's load UNH and see the level of premiums per expiration date. Okay, and what do we have? We have a similar setting, okay, where traders are clearly focusing on March 6th. Okay, this is where we have the greatest level of premium overall for the whole set of strikes. Okay, so I'm just gonna go ahead and expand this one. Liquidity levels here are more decent. Okay, so what I'm gonna do is right click to analyze and sell a vertical spread. Also, I didn't say it, okay, even though I was very happy when I saw the list of stocks. We are dealing with a $300+ stock. Actually, not anymore, 262, but still a pretty high price point stock, meaning that the higher the price of the stock, the higher the premium collected too. So that's nice. Okay, so we're gonna add a +1 standard deviation here. The question is, okay, if I was to do a call spread, we're dealing with call spreads now because it's going to be a neutral short. Okay, so if we were to do call spreads using March 6 expiration, how far price should go, and statistics suggest 285. Okay, so going back to the chart. Okay, going back to the chart, let's see what we've got. We got 49%. This is acceptable for neutral and non-directional. It would not be acceptable if it was to be a directional trade, but for neutral is fine. Okay, so if we look at 285, okay, so 285 is around here. Okay, so that would force us to use that UFO on the top. Okay, but anyway, before I point at that UFO, let me check pre and post market. So pre and post market are about the same. Okay, and by the way, it's 47%, so that is to be discarded. Okay, so we're gonna go back to a regular session, and if any, the UFO to be utilized would be this one. Okay, so we should be selling 303s. Okay, and that seems to be quite far, way beyond 285. So I am expecting to have a little bit of the same problem. Okay, in that stock, even though we have in our advantage the fact that that stock is way higher price point. So let's see, what did I just said? I said 303, right? So if I look at the 3 or something, we don't need to load everything. I'm gonna do like 30 strikes. Actually, we need more than 30 strikes, 40 strikes. Here we go. So if we do 303s, okay, that would be 302.5. We are getting paid 24, which is not enough, and therefore to be able to do this trade, we will need to move into the next expiration date, which is March 13. And now I'm gonna have to load everything in the end. The 302.5, that would pay you now 46, and that is acceptable from a premium point of view. Okay, now the question is, what about probabilities? Okay, so let's move into, instead of March 6, let's change it to March 13, because this will update the stats, and this is telling us with those dates, okay, 290 is the value. So going back to the chart, okay, if I look at 290, okay, so 290 would be here. Certainly, selling options above this UFO, it's certainly a safe thing to be done from a probability standpoint, because we're going to have 3 UFOs to defend ourselves, plus statistics. Okay, it's just stats, but certainly it's a great reference, isn't it? Statistics are suggesting that price is not going to get there from now until March 13. Okay, so looking good to continue the trade, and therefore I'm going to select as an option to be sold. Okay, as an option to be sold, I'm going to select the 302.5. Okay. So let me set the one I'm going to buy first. So I'm going to do 305. This is the one I buy. And 302.5. This is going to be the one I sell. Okay. So, okay. So what do we have there? Okay. 302.5. Okay. And 305. So I would be selling this one and get paid 46. And I will be buying this one and pay 32. So what's the net difference? It's 14 cents. Okay, the net difference is 14 cents. You can see that in the analysis tab right here, mid 14 cents. Okay, so now this is not good. Okay, why is that? Well, let me show you. Because even though we are indeed getting more than 35 for the option that we sell, we actually get 46 if I remember well. Okay, so 302.5. Okay, we get 46. So even though we get the premium we need based on the rules, the problem is that I also need to make sure that my net credit is going to be at least 15% of the difference between strikes. Okay, and how much is the difference between strikes? Well, the difference between strikes, it's $2.5, right? And how much is 15%? 15% of $2.5. So $2.5 times 0.15, that is 37.5. So I will need at least 37.5. I'm getting basically half. Okay, so what's the problem? Probably a little bit of lack of liquidity. Okay, probably a little bit of lack of liquidity. We got 35 to 58, 13 to 52. That's the one killing us. Okay, 13 to 52 to 52. This is the one that is really, really hurting. Okay, so what can I do here? Okay, well, I'm gonna move to the next expiration date is the monthly. So I'm counting on greater liquidity. Remember, monthly expirations are the options with nothing written in here. Okay, so that's the monthly expression. Those are the ones normally with the greatest volume open interest, therefore greatest liquidity, and normally we have an easier time to find a fair premium. Okay, so 40, 48, 52, 62, we can see more liquidity. Okay, so let's do the analysis. First, I'm going to move to March 20. March 20 suggests that 290 is where price will go to 91. Okay, so not too much of a big difference. Okay, and this is based on the implied volatility built in. And unfortunately, notice how we are still not getting the net premium we want. So the one you would sell, the 302, would pay you 56, but the one that you buy, even though liquidity is fine, I guess many people are taking advantage of this trade, and many people are buying it because the price of this option went high enough to give us, little net premium only when you look at the difference between the two. Okay, so I'm looking at maybe other ways to do this. Okay, so let me see. If I was to sell the 305 and buy the 307, I would get 10 cents different. That's not good enough. Yeah, it's really not looking good. Yeah, not looking good. There is a decent premium, but also I guess lots of buying, and therefore we are not getting the net differential that we need. Okay, so hey, no trade on UNH. It was looking promising, but no trade. So we'll move to Caterpillar. I am skipping IWM because it's an ETF, and we are now moving into Caterpillar. So looking at CAT. Okay, and remember, and I see your yes listening, good. So thanks for that. Remember, the life of a trader is to say no more often than yes, isn't it? So it's normal to go through a setup and discard the setup and then go for the next one, and it takes time to find setups that match our rules. Okay, so it's okay for us to be saying no a few times, not a big deal. Okay, so April 28 expiration is going to be the next expiration date. So Caterpillar is certainly giving us also freedom of choice when it comes to options premium. Okay, when looking at the chart, we got 48.99. Okay, so one and two UFOs. So we could be selling the the 137 and a half or 138, depending on what's available on the option chain. That would be good. Let me draw a line here, UFO number 1 and UFO number 2. Okay, moving to pre-post market, that 48.99 becomes 55, which is much better. And in this case, actually, you could count as this UFO as two UFOs. Okay, you could count as these as two UFOs in the sense that the other one was a little lower, this one is a little higher. So really, 133 could count as a valid place where to sell options. Okay, and then you have another place at 137. So certainly, that 137, it's looking like very, very strong for the trade to be taken. Because you have UFOs, you can see the white space now here. So because there were two UFOs in two different locations. Okay, so 137 would certainly be my favorite choice. But again, let's have statistics tell us where we should be selling options at instead of being biased out of what I said. Okay, so when looking at the chain, again, we can see 3690 is the greatest value. So again, March 6 is the clearest bet. I'm just gonna be a little sneaky and look at the front week as well, because since 133 is not too far, so if I was to find premium on the front week for the 138, no, I don't. Okay, so I'm not the only guy thinking about it. Many people have sold options already and price is low. So we're gonna be looking at March 6. Okay, so 137, 138, it's indeed providing great premium. Okay, and here we may have a way to make this trade work. Okay, so let's go ahead and right click and analyze and sell a vertical spread. I'm going to do the same thing I've been doing, which is to change the minus 5% so it becomes a plus 1 standard deviation, and that is 137.36. Okay, 137.36, where if I look at TradeStation, 137.36 is happening prior to 137.49. So yes, it is okay for me to go ahead and sell options above that mark. Okay, not that one. That one is not going to be working, but 137.49 is indeed a valid choice based on stats. Okay, so we're going to go for that choice, and by selling that, we could be looking at 137, 138. So let's begin with that approach. 137, 138. Actually, I already have it. Okay, and if we were to do that, we are almost there, because the distance between strikes is $1. Okay, remember what we said before, isn't it? We want to get paid at least 35 cents for the 137, and the 137 is paying us 62. So that is good. The other thing we said is we want to make sure that the total premium collected for the spread, okay, by selling the 137 and buying the 138, that total amount of premium is at least 15% of the risk. The risk being $1, 15% of $1. I mean, do I need to do the math? So $1 times 15% is 15 cents. How much are we being paid as we speak? 14. So we are 1 cent away. In other words, right now, if you place an order right now, you are not likely going to get filled immediately. Okay, but if this market, which has been moving higher, 0.45%, was to do something a little scary, something like maybe going a little up and then just pushing a little bit like that, probably that's going to spice up the price of the options enough for you to get an additional 1 cent. And let me tell you, this trade, look at that. We just saw 15 cents a second ago. We are about to have the premium we need here. So we are about to place an order, okay? But so get ready to work with me on that if you choose to go for it. In any case, I want to observe this a little closer to see if there is another opportunity. So I'm looking at 61, 36, 48, 36, 36, 29. So let me do another attempt, okay? So what if I do, instead of doing the 137, 138, I'm going to uncheck that one, okay? So instead of 137, 138, I do 137, 139. So what happens now? Okay, Now it's worse. Okay, it's worse because I got $2 risk. Okay, from 137 to 139, I got $2 risk. Okay, and therefore 15% of $2. Okay, that is 30 cents. And notice how here I only get paid 24. Okay, so this one I am further away from being filled. I'm 5 cents away from being filled, where this one is only 1 cent away from being filled. What if I do 138, 139? Well, if I do 138, 139, I have $1 of risk. So I'm looking for the same 15 cents, but notice how, because those options are a little further away, there is a little bit less liquidity, and therefore I'm not getting the 15 cents I want. Okay, so in other words, this trade would be valid. Notice how now it's flashing 15 again. Again, you're going to have to be a little patient. Okay, you're going to have to use a limit order. I'm just going to do it. I'm going to go ahead and trade this spread, the 137, 138. Let me place the order, and I'm going to write everything on the chart because I am aware I went a little fast. So now notice what I just did. I just click on the arrow to make this to be a limit order, limit price of 15 cents. The current midpoint is 14. So if I place an order now, which I'm going to do oh, by the way, let me make it day only. Okay, day only. So I'm going to place the order 1, 2, 3. So if I place the order, I am not anticipating being filled immediately. Okay, so the order is there waiting to get filled. The Caterpillar spread for 15 cents. I am not expecting to get filled immediately. The midpoint is still 14, so I'm going to have to wait. Okay, but as long as the market does a little bit funny, the prices of the options will spice up, and you should be able to get filled. Okay, so while you guys are probably considering entering an order here, just to be a bit more visual, I just want to type on the screen what I've got. So what I've got is a trade where we are buying the 138 call. Okay, we are selling the 137 call. We are doing that using a March 13, 2020 expiration date. Did I say all of these right? I think so. Let me double check. No, March 6. Okay, little mistake there. March 06. Okay, March 6. That is what we're doing. Okay, so this is the trade that we just put together. This is the trade I just placed in the account. And just to be visual, that's what we're doing. In other words, this trade will make a profit for us from now until the 6th. As long as this market does whatever it does, okay, goes up or down, it doesn't matter what it does, as long as it remains below 137. If it goes above 137, then we have a problem. Okay, so that's the trade. Okay, this is the trade. And a bit more about risk. So remember, this trade has $1 risk. Okay, but also you're gonna get paid 15 if you get filled for you to take this risk. So in other words, the most the spread can lose for you is 85 cents, which is $1 minus 15. That's 85 cents. So every option is worth 100 shares. So that is $85 per contract. So in other words, let's say you have an account where you are happy to risk $250 per trade. This is just an example. So you would take the amount of money you want to pay to see what happens next, which is your risk, 250. You divide it by 85, which is the risk of this trade, and that will tell you that you can take this trade with 2 contracts. Okay, so you would come in here, and instead of -1, you will make this to be -2, and then execute the trade. Okay, my case, I'm going for 1. I always use 1, so that way you guys can use me as an example and then use the right size for yourself. Guys, I need a sip of water, and I'm back with you in just a second. Sorry for that. I really needed to drink. Anyway, looking at the comments chat box, everybody, I believe, is okay. So, guys, if you guys are executing this trade, either real or paper money, I'd love to know. Let me know. If you need me to re-explain anything, this is the time for you to speak up. And in the meantime, I am now getting prepared to go for the next symbol, which is a stock from a different sector. Nice for diversification. This is a JP Morgan. JP Morgan showing 50% probability, almost 51, That is a lot of institutional interest. JP Morgan, when it comes to earnings, has earnings. You have your order in. Very nice to hear, Lilan. JP Morgan has earnings happening on April 14. Okay, April 14. This is the date for the earnings. So again, we got plenty of flexibility on which expiration date to use. Okay, and we got good probabilities and multiple UFOs. So this is actually looking good for a trade to work. Okay, but again, let's not be biased. Let's just follow the process. So typing JPM, looking at the option chain. Same behavior. The next expiration date is the one with the greatest premium. This is quite a normal thing, but certainly it's nice to see that is happening in most stocks, which somehow it tells you about the view of options traders out there in the marketplace. So I'm just gonna expand this one, and I'm not gonna think about this too much. I'm just gonna right click and analyze and sell a vertical spread. Okay, so I have this trade in the background, in the bottom part. I meant to say, yeah, we don't need to place an order yet. Here we go. So we got the spread here, and pointing at the 1 standard deviation above, that brings prices up to 134 something. Okay, so back on the chart, where is 134 something? Well, 134 something is right there, okay, which is quite far, to be honest. Okay, and when looking at this, in this time frame, we would have 3 UFOs. Okay, so we have 1, we have 2, and we have 3, and we're moving to pre-post market to see what's the stats. 50. We got 53, even better. So we got 1. So that guy would be number 2. We got 1, and this one, would be another valid possibility for the trade. Okay, so again, when it comes to above 134, we will need to go back to the regular session and lean against those UFOs around 137 something. So really, it's a little bit of a borderline type of situation. We saw that earlier as well with UNH, I believe it was, right. So statistics suggest 134. The UFO is 133.75. Basically, is like 25 cents away. It's such a tiny amount of movement, right? Now, having said that, do we break the rules? Okay, of course not. What a question I just sent to you. We never break the rules. Okay, so now what would you want to do then? So ideally you will want to wait for this to maybe drop a little more, and then statistics will be different, and now instead of 134 it's going to show you 133.60 or something like that, and then the trade could be executed. Okay, but what we have is what we have. So given the fact that we got so many UFOs prior to 134, and given the fact that that stock is not a cheap stock, is $100 over per share, I want to look at the one with 2 days to expiration to see what we've got. Okay, the 131, it's providing 36 cents. Okay, so let's see what happens if instead of March 6 we use February 28. Okay, this is suggesting 131.6. Okay, 131.6. 131, sorry for that, 131.6. That would imply to be utilizing that one. Okay, so we could be using the 132 as long as we have premium enough on the front week for the 132, which I don't think we will. So 132 pays 20 cents, and that is not enough. Okay, so we need to discard February 28, and everything we're gonna do will be on March 20. Unfortunately, the 137s are paying only 18 cents. Okay, and I'm pointing at the 137s because we cannot use 133.75. We need to go for the next one. Actually, it's not even 137, it's 138.3. Okay, so basically we need to be looking at 138. So that forces me into March 13, probably even March 20. So 138 is paying 26. March 20 for the 138s, it's paying 41. Okay, 41. So that's valid. Okay, that is valid. So okay, before we get too happy, let's look at March 20. Okay, and statistics suggest 136.38. So certainly we are not likely, based on stats, going to reach 138.37 from now until March 20, which is a little less than 1 month. And therefore, selling a spread which is 139, 138 would make sense. Okay, so selling the 138 minus 1, red color, selling the 138 and buying the 139 would make sense. From a statistical point of view, would make sense. Problem, we only get $10. Okay, and I was kind of noticing that in the option chain. By the way, this is a problem that many times you will have when you use monthly expiration dates. Many more people use them. In one hand, is good, is more liquid. In the other hand, more people are doing the trade we are planning to do. So what happens if more people are trying to sell the 138 and buy the 139? Well, then the 139 becomes more expensive, the 138 becomes cheaper. And what happens then to the difference between those two values is less. Okay, so it's more difficult to have the 15 cents we are looking for. Okay, so 32 to 24 is 12 cents, 24 to 19, that is 5 cents. So yeah, so it's not looking like JP Morgan will be a good candidate. Okay, again, probably with March 6th you may have a trade. Okay, but you will need to wait again for JP Morgan to react to this UFO, fall down, and yet remember we had a 133.75 option there. And then you can do your spread right on top of that level. Okay, but you will need JP Morgan to fall a bit first for statistics to give you 133.75 or below, which is not the case as we speak. Okay, good. So let's continue. So IBB, XBI, all of these are ETFs. So the next one we have is ABT, about laboratories. And we're going to look into this one, okay? I have to apologize one more time. I need another sip, guys. Okay, so about laboratories, 58%, multiple UFOs, lots of institutional interest. That's beautiful to see. 58% with stocks. This is really rare. So very nice to see. Earnings for Abbott, ABT. Kind of interesting, right? Because you would think that pharmaceutical in the industry would be very happy that there is a virus panic out there because this equals business. But the people that own the stock are choosing to read it differently. Okay, this is where interpretation becomes subjective. To me, if I was to be a drug company, I would be very happy there is a pandemia from a business point of view. Don't get me wrong, please. But shareholders of that stock are not thinking about it this way. I'm not sure why is that. So anyway, 15th of April. So that gives us plenty of flexibility to play with expiration dates. So let's take a look at what we have. By the way, earlier, one more comment as well, because not everybody in the group today has been following these sessions for a long time. Some of you have been with me here in the sessions for a long time, and you probably even guess already what I'm about to say. But for the ones of you that have been with us less time, so I want to say two things as a continuation of what I said before. Okay, the one thing I said before is the job of a trader is to say no more often than yes. Okay, that I said before. Now I want to add a second thing, which impacts very, very much everything that has to do with credit spreads. Okay, credit spreads are trades that are very likely going to work well because you have the direction in your favor and everything else. So you have the climate, you have the UFOs, so you have many things in your favor. But because you only get premium from one side of it, having the trade to work well from a point of view of meeting the premium requirements, it's tougher compared to iron condors where you get premium from the put and the call side both, and it's now way easier to get those trades to work well. Okay, so again, the job of a trader, which is to say no more often than yes, applies even more intensively when it comes to credit spreads. But it's worth it to do the research that we are doing, because when you find a trade, those trades are very likely going to pay well. Okay. Cool. Okay. So anyway, sharing my thoughts with you guys. So again, loading Abbott. Okay. And again, we get to see one more time that March 6th seems to be the date. Okay. So right click. Wow. Huge amount of premium, 84 to 83. Huge amount of premium there. So right click, analyze and sell a vertical spread. And let's do the math. Okay, we always use statistics, so that way there is absolute no bias or gut feel when you look at the chart. Like, "Oh, I feel this is going to happen." That's so subjective, right? So we don't want to fall into any of that. Okay, so let me see what's going to happen with Abbott. Okay. So with Abbott, statistics suggest that using March 6 expiration, that market should move up to 86 point something. So that is something that could happen easily. And where is 86 point something? Where 86 point something is around here. And therefore, that would put us in a position where we will need to be utilizing this particular UFO. Okay. Now, having said that, we got 58%, which is amazing. Not common for stocks. Okay, stocks are fragile, remember. But when we look at the pre-post market, we also got 48, and guess what? That UFO coincides. Okay, and then we have another UFO here, but really that's not going to be that relevant because statistics are suggesting 86 plus anyway, and there is no other UFO. So that's the UFO, guys. Okay, that's the one we got there, 87, 85. So basically, utilizing the 88 options, that's going to be the choice. And I'm just a bit concerned about how much we're going to get paid. Yeah, we only get paid 11 cents on March 6th. So that means that we're going to have to move to March 13th for this trade. And we're looking at the 88s. We're still not being paid enough. It's only 20 cents. So I'm going to have to move on March 20. And the 88 now is paying 34. Yeah, it's paying 84. So we're gonna say that's valid. Okay, we'll look at this later on. Okay, but really my concern now is about stats from a point of view of price movement. So if I do March something, that becomes 87.56, and that UFO is 87.85. So you know what? It does work. Okay, it does work. So let's work on the trade and see what we've got. So I'm gonna do 89.88. So I'm going to do 89.88. That's going to be the plan for the trade. And this, first impression is that I'm not too happy. It's only 12 cents. Okay. So let me go ahead and look at the option chain to see what we got. Yeah, actually, we can try something here. So let me see. Again, I want to see the chart. So it's 87.85. Okay, so 87.85, this also could be an opportunity for us to use the 87.5 strike instead of the 88. Okay, so let's see what happens if I do 87.5, okay, together with the 88.5. Okay, so what happens here? So now we are getting 14 cents. So this is a very similar situation to the one we had earlier, isn't it? So if we are patient, we may get the premium we want. Okay, but I also want to check what happens if I do 87.5 and 88. So what happens if I do that? Because if I do 87.5 and 88, problem is that I will get paid very little premium net, okay, because I get paid 7 cents only. So if I want to have an okay profit, I need to use so many contracts, okay? That obviously is not ideal. But at the same time, I'm not sure what I did with the calculator. Okay, now. At the same time, if you think about the difference between 88 and 87.5, well, I don't need to do this math, it's 50 cents, right? And how much is 15% of 15 cents? Is it's 7.5. Okay, and we are getting already our 7 cents here. So basically, 7 cents out of 7.5 compared to 87.5 to 88.5, and we get 12 cents. Okay, so 12 is further away than 15 compared to 7 is to 7.5. So it's looking like the setup with 87.5, 88 probably makes more sense compared to the other setup. Okay, now the only problem with this setup is that you will get paid $7 per spread only. So let's say you want to make $200. If you want to make $200 and every spread will pay you 7, you need to go with 28 contracts. Okay, and what's your risk? Well, your risk is $50 minus 7. How much is that? It's $43. So if you get 28 contract, you are risking $1,200. Okay, so again, in the case of some of you and some of your accounts, this may make a lot of sense. In the case of some of you, you may not be so happy. Okay, so what I would do in this trade, and you can see now it's dropping to 6. So not it's really borderline. Okay, good news is that all the rules are met. The premium is the problem. Okay, and again, this is because there's been a lot of premium out there, and many people have been taking those trades, and therefore premiums go down. Okay, so if you're gonna take this trade, okay, and given the fact that the ask is 6, the bid is 8, okay, so the midpoint, I would say it's pretty likely a price where you're gonna get filled, and therefore I will get additional picky here, and I will go for 8, even though you may need to wait an hour or two to get filled, and you may not even get filled. But given the fact that you need to use so many contracts, I would certainly be very, very picky. Okay, so here's a trade. I'm just gonna go ahead for trade. I'm gonna make this to be 8. And I'm going to make this to be day, okay? And you decide how many contracts you want to use in the trade, because everybody has different risk management rules, isn't it? So I'm going to go with this trade, place order, yes, 1, 2, 3. That's it. So I got the order in the system. So we got a trade with a Caterpillar that have not been filled yet, okay? And we have a trade with Abbott that is waiting to get filled as well, okay? So we have, notice how we are shooting for 15. Things are getting cooled down a little bit, and this went to 12. We are looking for 8, and this went from 7 to 6. So the market is cooling down a little bit. Okay, it's 1 p.m. New York time, if I'm not mistaken. Around 2:15, which is an hour and 15 minutes from now. This is when most of the fund managers are back from lunch and taking their final decisions before the market restart trading heavily in the afternoon session. So you place the order now, you may get filled an hour and 15 minutes from now, but those trades do meet the rules. Okay. We are 3 minutes to go, guys. Okay, so Citibank. You know what? I'll pass on Citibank because we looked at JP Morgan, which was a finance stock. So I'll pass. EOG is energies. We didn't do anything with energy, so let's take a look at EOG. So what's going on with EOG? Earnings. Oh, earnings are about to happen. Earnings will play on the 28th, so no way we're going to do EOG. What about Las Vegas Sands? So LVS. Earnings happening here on April 22nd. Okay, so that's good. 48%. That's good. Wow, the UFO is so far out. What about pre-post market? No, they are not closer. So I'll pass on this one. Okay, I'll pass on this one. I'm looking for nearer UFOs. Delta Airlines. Delta Airlines, airline company is very badly hurt, isn't it, with the coronavirus? So we got 49% earnings for Delta Airlines, DAL. Are happening on April 9. So dates are not a problem when it comes to flexibility. We got 49%. So let's take a look at Delta Airlines, see speed of the light if we have a trade or not. And that way we'll conclude the session for today. So 3 orders in the system. We got the midpoint is 8 now. Okay, midpoint is 8. Okay, so in a real account, you should be filled on the Abbott trade. Okay, in a real account, you should be filled. So Delta Airlines, what do we have? 56%. Again, second expiration date is the one with the greatest amount of premium. So let's take a look. Analyze, sell a vertical. Okay, so using March 6, we're talking about 54.82. So 54.82 is going to be somewhere here. So certainly that UFO will work, which is 49%. So that's good. What about a regular session? The 49 becomes 52, even better. What did I say? I said 54.84. Okay, 54.84. In other words, that 54.71 is not good enough, so I will need to use the 55.48. Okay, so that's the value I'm going to use. So we are looking at the 55s in the option chain. So how much I get paid for the 55? I get paid 24. So that is not good enough. So I need to move to March 13. The 55 is now paying nicely, and the question, of course, is probability going to be in my favor or not? Okay, so March 13, I'll do 53, 54, something like that. It doesn't matter really. So 13 of March, that is bringing statistics to 54.74. Okay, 54.74. Which is again above this UFO. So we are still dealing with the 55. Okay, so we may have an opportunity now. Okay, we're gonna do 55, 56 and see what happens. So if I do 55, 56, okay, I get paid my 15 cents out of the bet. Okay, and I do have a $1 strike price increment. So let me check the option chain just in case I see something. So we got 46 and 31. That's your 15 cents. Yeah, if I do 56, 57, that's 31, that's not good. But if I do 55, 56, I do get the 35 cents minimum I need, plus the difference is 15 cents, which is 15% of the $1 strike price increment. So yes, it works. Okay, it works. And therefore, I'm just gonna execute this trade. This is the third trade of the day. They're all the same, by the way. Okay, so I've been using stocks of a different sector on purpose to create some diversification. But of course, remember that you may have other positions in your account, so you don't necessarily need to take all the trades I am planning today. Just keep that in mind. Okay, so day trade, midpoint is 15. Let's go for it. Place order 1, 2, 3. Yes, and yes. And the order is now in the system. I got 3 orders waiting to get filled here with Delta Airlines, Abbott, and Caterpillar. And I know on the last one, I did rush a little bit, but yeah, so I had to because of the time. Okay. Anyway, everybody, today was a credit spread day. That's the only thing we've done. Call spreads. Okay. We tried a put spread, but it didn't work. So everything has been call spreads, and hopefully you guys were able to follow me. And yeah, and you are likely going to get filled in some of those trades. So hopefully this will happen soon. Remember, 1 hour and 15 minutes from now, the market should pick up some speed. So that may be the time when you get filled. Okay, so be patient. Okay, notice I use day orders in all cases. So if I don't get filled, all those will be canceled for tomorrow. So I can go ahead and reassess my markets. Okay, cool, everybody. My pleasure to have you in the sessions. I will see you on Sunday. We have a sharpening session on Sunday, isn't it? So see you then, my friends. You guys take care. If you have any question for the sharpening session, make sure you send it in. Okay, I'll be more than happy to look into it, and even bring your questions to the session as well, so I can give you a complete, detailed answer with chart examples and everything that may be needed. But anyway, my pleasure, everybody. See you then. Take care. See you soon. Bye bye.